We often talk about how we find ourselves in the middle of a reshaping of a new paradigm in terms of finding a new platform on which this global financial system, a new global financial system, is going to be built upon, based on this new technology known as the blockchain technology. We often, with we, I mean us crypto enthusiasts that are deeply involved and passionate about the blockchain technology, we often discuss how DeFi is the future, how proof of stake platforms are the new platforms on which global finance is going to be built upon because it's neutral, because it's transparent, it's accessible 24/7, it's liquid, more efficient, and so on and so forth. We could count so many benefits. However, just lately, to be specific, on August 5th, as we're going to go through this session today, there are literally momentum being built. Not only that, but laws are being put into place. Now, this was just a statement, right? That was taking place, but this statement came from the SEC, the US Security and Exchange Commission. We all understand how, under the regime of the former chair, Gary Gensler, the SEC was suing anybody and anything that has anything close to do with DeFi, staking, Ethereum, anything like that. But now we see a 180 change, and this is what we're celebrating. And it's not enough to just celebrate and be excited about the statement that was made that is so pro DeFi, pro crypto, pro blockchain, pro staking platforms, and even goes a step further into liquid staking. But we might miss the whole point if we really don't dig deeper and take our time to really understand what this means, what impact will this have moving forward to us as crypto enthusiasts. So let's break this thing down right here. Let's jump right into it. As you see, the topic of today is, like we just discussed, it's about institutional adoption of Ethereum staking. And this is literally the quiet revolution that is happening in the background. So let's jump right into it. So the SEC, like we said, it's issued a staff statement, right? This is not into the law yet. However, like we said, it's not binding, right? But it's a guidance to address certain aspects of liquid staking. We already laid the foundation that staking in its own, protocol staking on its own, is not considered a security. So we've already taken care of that. However, this is talking about liquid staking. So what is liquid staking? Liquid staking in particular that they're talking about here is allowing participants to deposit their crypto into a third-party staking service provider, right? And then for that, they're receiving a second token, so-called receipt token. With this receipt token, you can now, and this does not require any securities law disclosure, so the SEC said. So that means that liquid staking tokens, receiving a second token after you stake in a third party's staking platform, that is also not considered security, right? Because not everyone has their own staking platform like we have. Like in BULLRUN ecosystem, we have our own protocol, we have our own staking platform. But this now talks about institutions that want to offer staking as a service for investors. So investors can come and use their staking platform and they charge fees for that. But on our ecosystem, BULLRUN, we have our own private individual staking platform taking place on a DeFi level. But more to that at the end. This is just to clarify what this is. So liquid staking is for if you stake your crypto, deposit your crypto, right, into a third party staking service provider, right? This is not considered security. So obviously that means that since we have our own staking platform, it's definitely not a security, especially it being a DeFi staking platform. So we'll also get into the requirements that need to be met in order not to be considered a security as we progress. So this new SEC staff statement obviously signals how the agency is thinking about the issue and suggests that any crypto industry participant who follows these guidance will not be sued, right? So because previously so many entrepreneurs, crypto project were being sued, so innovation stalled. But now with this new pro-crypto administration, many things are taking shape as we're about to see. So again, participants in liquid staking, including depositors and providers, do not need to worry about securities laws disclosure. It's not a security. This is a major statement. This is a major statement, and this is specific to liquid staking, right? This is specifically for liquid staking. We just saw what liquid staking is send us putting your assets, locking your asset into a third-party staking protocol provider, right? So not everybody, like we said, has their own staking platform. So what I want us to understand from this article further is this: like liquid staking allows users to lock up tokens in a proof of stake blockchain, right? While maintaining access to your own fund. This is the key right here. This is what DeFi is all about. So these tokens that you then receive, you can use them in a DeFi, in decentralized finance activities. You can put them into DeFi protocols to lend or borrow against your assets, use them as collateral, so on and so forth. So this is a major way, like we used to say, this on Ethereum is where the new global economy is being built. And step by step, we're seeing that allowing liquid staking to take place, especially on an institutional level, opens doors for derivatives, right? Because you're using these as a derivative, right? So like we saw here, if we go up here, we realize this. So community, what I want us to understand is that there is currently 67 billion in total locked value right now. And I'd like us to understand that where is all that total locked value? Where does it take place? It's on a DeFi platform. So I'd like us to briefly see where all of that takes place. So if we come over here, let's go to DeFi Llama. And then we realize that indeed there is 66.8, so roughly 67 billion. This is all of the blockchains like Ethereum, Solana, Terra Classic, Binance, Avalanche, so on and so forth. All of it comes to 66.7, so roughly 67 billion. But if you look at Ethereum on its own, it's sitting at 51. So out of 66, out of 66.8, 51 of that is sitting on Ethereum alone. So that's over 77% dominance. So this just shows you how dominant Ethereum is in terms of DeFi products and liquidity locked up in DeFi. So when we read articles such as this, where it tells us that DeFi is coming into law and products are being used, and the SEC is literally announcing that staking and liquid staking are not considered securities, and that now institutions can now create products with staking products, such as ETF issuers, for example, or staking as a service providers. Now, those are new articles that can be offered by these institutions. So community, there's one thing that I would like us to understand, and such protocols like that are liquid staking protocols like Lido, Jito, and Rocket Pool, right? So let's move further and understand even more. So on this other article, I'd like us to just jump into something even deeper. So like we said, we clarified that the SEC clarified that crypto liquid staking is not a security, right? So of course, this is a defining moment for DeFi and ETFs, because right now we just had that NASDAQ and BlackRock have applied with the SEC to be able to allow it to offer Ethereum ETF staking, right? NASDAQ and BlackRock have applied for it. So with all these more clarifications that took place just 2 days ago, this opens doors, right? And clarifies all the uncertainty for DeFi protocols and ETF issuers, right? So what does all this mean to us? What does all this mean to crypto and staking tokens and institutional adoption? So just briefly, we want to really just hit on certain aspects here to make sense of this. Like we said, all of this was issued or was announced on August 5th, just 2 days ago. And this is literally a major step forward, right, in bringing certainty into DeFi, and especially for DeFi protocols, and also for institutions aiming to launch staking-related investment products. So this opens doors for all these financial institutions and non-financial institutions to get not only involved into blockchain, but also DeFi, and start producing products that they can launch on-chain and issue and introduce to us retailers. And this is the official article that we saw, the announcement that they launched, like we said, August 5th, and it came from the US Securities and Exchange Commission directly. And this is where they were talking about how they're sharing their view on liquid staking activities. Like we said, this is not the official law. However, it is an indication of how they think, right? And what this means to us moving forward in the crypto space. So another thing that I want us to now break down and look at is the key criteria. So how do we determine, how do we understand what we have to consider? What is considered not a security, right? What is not considered a security? So we have certain criteria here that I really want us to understand and dive deep into. So in order for your staking platform, staking protocol not to be considered a security, needs to meet certain conditions, right? Staking activities do not constitute securities if they meet following conditions. What's the first one? So the provider of the staking platform performs purely administrative services, right? And such as, they're right here, such as custody and token issuance. The beautiful thing about DeFi, it's based on smart contracts. So in our case, for example, because it's a smart contract, the individuals always have full custody of their tokens, and we're not issuing any new tokens. It's actually based on trading volume. And instead of issuing new tokens, this is now for BULLRUN, you receive USDC distributions based on the trading volume. So this is the number one criteria in general for trading platforms. You can't, you can only be an admin, purely admin, just minimal services, right? Such as custody and token issuance. So if you are the custodian and you issue tokens for the rewards, that's not considered. However, if it's decentralized finance, obviously you already qualified because you don't have any intermediaries. You have nobody in between. What's the other criteria is that these staked assets are either fully backed one-to-one, if you're staking with a third party, right? Or that you have some sort of ways how you're retaining liquidity so that when your participants, staking participants, are ready to unstake and withdraw their funds, there will be liquidity there. So this is another important aspect that needs to be looked at. This is very important. And another thing is that users retain control over their assets. This is another major aspect. Users always have to be retaining their own assets and have full control over them. That's another beautiful aspect of being in DeFi. Decentralized finance, you're dealing directly with smart contracts, and the users of these platforms, staking platforms, are required to always have or retain full control over their assets. And that's the beautiful thing about this. Another and final one is the economic return. So the distribution, staking rewards come directly from the protocol, from the staking platform, off the blockchain directly, and not from the provider, not from the developer, not from the provider of that staking platform, but it should be within the protocol itself, making the most out of the blockchain technology directly. Then it's not considered as security. How beautiful is this? This summarizes why we always stress on addressing the 4 challenges we faced with in the industry community. We always talk about the 4 challenges, which is inflation, lack of liquidity, unsustainable staking distributions, and using your volume efficiently to keep retaining sustainable staking, accumulate liquidity. Why? Because your staked assets need to be either backed if you're using a third-party staking platform, or you should be retaining liquidity so that your participants, users of your platform, whenever they're ready to exit their position, they have liquidity. So you see how everything is falling in line perfectly, that you have a platform that is directly using the protocol, the blockchain, the mechanisms of the blockchain technology directly to retain the liquidity, to bound the supply. We'll get to that again, to issue sustainable distributions, taking rewards without causing inflation, and it's using that volume efficiently to achieve all of these. So these are the criteria, community, that we need to really be aware of and understand. So let's move further. We just identified just once more that there's in total 66, let's say 67 billion in locked value, total locked value, like we see here, right? Overall across all blockchains, but on Ethereum alone, we noticed that it's 51. So that's 77% locked value of total locked value is on Ethereum alone. Why is this so important? It's because we need to understand that Ethereum is literally the hub, the home of DeFi. And these laws that are being passed right now, they serve to remind us that we have a blockchain that is already on its way up in the early stages to be dominating and to literally monopolize the DeFi projects, DeFi protocols, liquidity, real-world assets, tokenization, stable coins, all of these things, as we're about to see. So if you include stable coins, talking about stable coins, the total value locked in DeFi across all blockchains, the entire industry, is 138 billion. And again, if you look at Ethereum alone by itself has 83 billion. So that's, again, over 60% of all DeFi activity among all these blockchains is on Ethereum. So one blockchain alone is dominating both total locked DeFi in locked value in DeFi, including stable coins as well. So this is just to verify and to show us that whenever we talk about how Ethereum is literally the hub, the home of DeFi, it's not just wishful thinking. It's not just being hopeful about something, but it's a fact. That's just what it is. And this is why institutions choose and prefer to build infrastructures on Ethereum and to build products on Ethereum. And this is why when we see articles such as this, that staking and liquid staking are not considered securities, this opens the gates for financial products to be produced by these financial and non-financial institutions in terms of ETFs or staking as a service providers and so on and so forth. So we see here another article talking about how Ethereum is outperforming Bitcoin, right? Amid a wave of institutional investment. So institutions are not just looking at Bitcoin alone, but they're also focusing on, like right here, institutions are no longer just looking at Bitcoin. when it comes to crypto? Treasuries. There's now treasuries directly. But now they're also looking at Ethereum, and Ethereum has been rising 64% within the past 3 months. And it went from 1,800 to 3,600. However, during the same period, Bitcoin just rose 10%, from 94,000 to 115,000. And we noticed all that shift happening. This is not to say that one is better than the other, but this is to identify that whenever we see a shift moving from Bitcoin to Ethereum, when Ethereum dominates Bitcoin, that's always a very sure sign that altcoin season is kickstarting. Altcoin season is always triggered by Ethereum first. So Ethereum kickstarts the altcoin season. And whenever it dominates or outperforms Bitcoin, that's a clear indication that indeed we are in a bull run, the early stages of it. Because once Ethereum starts kickstarting, it will facilitate it will actually not just facilitate, but it will also trigger and be the catalyst for the rest of the altcoin season to also take place. So now that we talked about this community, I also want us to understand one more thing. And I don't just like us to hear from myself or from these articles that we read, but let's just briefly also understand or listen to one other opinion as well, right? So let's briefly tune into this and just listen to what these individuals are talking about, just 1 minute or 2 minutes. So as we clearly see here, the individual is mentioning staking, restaking, which is liquid staking. Actually, it's just a different form of liquid staking, but it means the same thing, right? So staking is one thing, like you stake directly through the protocol or through validators, and restaking is when you get a second token from whichever platform you're staking from, and you can use that second token now, bringing it into DeFi and use that as collateral. This is where derivatives comes into play, right? This means that the derivative is your initial token that you staked in the first place, and now you're getting a second token that now you can use for the DeFi world. And this is now being legalized. This is being worked on as we speak, and hopefully it's going to be placed into law and make it permanent now and binding. That's the whole idea. So the takeaway of this, I just wanted us to understand that yes, staking, restaking plays a major role, and this sets Ethereum apart from Bitcoin being used as a treasury asset. Because as a treasury asset, you want an active asset, one that even if nothing is happening, even during a bear market, you still receiving staking distributions. You're still earning passive income, because that's what treasuries need. You still always need to be able to get into receive liquidity, however, without having to mint new tokens or print new fiat currencies and cause inflation, dilute your purchasing power, and increase your debt, like we are experiencing right now in this current monetary system. So due to this, it sets Ethereum in a whole different league, to be a reserve asset compared to Bitcoin. Again, this is not to say Ethereum is better than Bitcoin. They just serve different purposes. One is just inactive asset, like Bitcoin is just buy, hold, and wait for the price to go up. But Ethereum is an active asset. Like you said, you can stake it, you can borrow against it. It gives you yield. That's the major, without causing inflation, right? And at the same time, Ethereum is still more deflationary, actually, than Bitcoin is. All of that. So this is just the takeaway of this is for us to understand that staking and receiving yield is one of the aspects that institutions are looking for. Compared to Bitcoin, Ethereum gives you yield, staking rewards. It's an active asset, and that makes it a more preferred asset, strategic asset in comparison to Bitcoin. So let's not just take his word for it. Let's look at another article and another individual. So this is the SharpLink co-CEO, right? Also known as Joseph. His name is Joseph as well, and we'll go into him deeper at the end. So he's also saying that their treasury strategy, Ethereum treasury strategy, goes beyond just staking. So far, we've always just talked about staking. Staking plays a major role in stabilizing the network and securing the network, making the token, the ecosystem, less volatile. In any early stage of a new industry, it's always extremely volatile. But now with a new twist where you have Ethereum as an asset and a technology with this staking capability, it gives a new industry the ability to be in the early stages. Yes, it will still be volatile, but the more Ethereum is being adopted and staked, it's going to be very stable in the very early stages already. So this is something that is very important, and this is exactly the reason why all these Ethereum treasury strategies are being built to support the security, the stability of the ecosystem, of the Ethereum ecosystem, because more ETH is staked, more stable ETH becomes, more secure ETH becomes. Why? To set it up to be the ultimate strategic reserve asset and to make it to be the strategic collateral for the derivatives market. So all of these things are being lined up and set up perfectly, but let's understand what this individual is saying. Let's go further. It goes beyond staking, right? It's not just staking. Staking is one aspect, but what else? So as Ethereum cements its role in tokenization, so beyond staking, Ethereum is cementing itself in the world of tokenization, tokenized assets, in the world of stablecoins, and in the broader financial market, global financial market. So it's more than just staking. It's tokenization of assets, including stablecoins, and also just in the broader way of global finance, like we just saw. Global finance includes tokenization of all these global assets, real estate, stocks, bond market, commodities, and so on and so forth. And also through staking, you get even more financial products. You can be a staking as a service provider. You can, if you're an ETF issuer, now you can issue staked ETH ETFs, and so on and so forth. You can be creative and now provide products that have a yield through Ethereum that is both an asset but is also a technology. There has not been anything like that. Another thing I want us to take away from here is that what this Joseph Chelom says, we believe in Ethereum as a transformational technology and a long-term opportunity. This is what many people really miss. Yes, Ethereum is an asset, but most importantly, it is a technology. Let's never forget that. Ethereum is a technology. And this technology, like the internet in the early 90s, also is an asset at the same time. That is what sets Ethereum apart so much. And this technology that is an asset is deflationary. You can stake and it gives you yield. The more you stake it, the more stable it becomes. The more it's traded, the more deflation get. Is giving you new liquidity into the, is providing liquidity for your company, your treasury department, or if you're a government, it gives you fresh liquidity to use to inject into the economy without causing inflation. And it does all of this while being open and global. Everybody can participate in it because it's neutral. And this is exactly the other point that they say. Their investment thesis is Ethereum will be the neutral. It is neutral. It has no jurisdiction. It doesn't belong to China, to US, to Africa, to whoever, right? It's a neutral technology. And it's decentralized, like we say. It's a decentralized platform that will secure stable coins, right? How do you secure stable coins? Staking. This is why staking plays such a major role. Staking secures the network and stabilizes the network. And it's also a range of tokenized real-world assets, like we said, and other economic activities for the next generation. You can think of it as the trustware of global